What is being over leveraged? So, over leveraged is a term that's being thrown out around a lot, especially as we're facing this potential downturn. And several people have asked me about what being over leveraged looks like because they haven't found anybody that could give them a clear picture in quantifiable terms. So, basically, in a nutshell, being over leveraged is when your expenses outweigh your income. And that can happen from several ways. So, one way it could happen is if somebody buys for appreciation instead of cash flow, meaning when they first buy the property, they buy the property knowing that they won't make any money on that property and rental income, and that they'll probably have to pay the bank every month in addition to their rent that they receive to cover their mortgage, but they're expecting that property to rapidly appreciate. Another thing that happens is when people execute the BRRRR strategy, they may take too much money out when they're doing their refinance to now their property doesn't cash flow. So, or it cash flows very minimally. But let's say if it doesn't cash flow, now once again, they're investing for appreciation and not cash flow. Or they were investing to get that lump sum of money that they were able to pull out tax free and not for their actual cash flow. Or you have people that invest, it could be through the BRRRR strategy or just because they bought wrong, where they're typically on normal months, their income exceeds their expenses, but let's say in a downturn, or let's say in a downturn, if their tenants can't make their rent payments, now all of a sudden, one tenant misses a month, or if one tenant or two tenants miss a month, now all of a sudden their expenses outweigh their income. And or another way that could happen is, let's say your expenses were more, I'm sorry, let's say your income was greater than your expenses, but then as you go to renew leases, and we've been in a downturn for a while, now the rental rate is less. So the leases that you're renewing are for less than what your previous leases were. So now you have less income, and it can be less to a point where now your expenses are outweighing your income. So those are typically the ways that people get in trouble when people say they're over leveraged. And when we talk about leverage in general, leverage is money that doesn't come from you but comes from another party, most of the times a bank, to able to put money that you have towards something to be able to buy something that's a lot more than what the money that you have. So for instance, a bank, if you're doing regular, let's say conventional financing on a deal, you can go to a bank, you can put down 20% and the bank will give you 80%. So you've leveraged your money to be able to, let's say, afford a $100,000 property. If you put down $20,000 and the bank gave you $80,000, that's leverage in a nutshell. So when the bank looks at leverage, what they're looking at as to make sure that they're secure in their position, they look at something called the debt service coverage ratio. And what that means is they're looking to see for every dollar that you have to pay them in a mortgage, they want you to bring in at the bare minimum at least $1.25 to $1.30 in rent payments. So that way they can be secure that you're going to be able to pay them their mortgage and then have money left over to operate your property and then possibly turn a profit. So when you look at numbers behind that, let's say if your mortgage payment is $1,000 a month, the bank is going to look and say, okay, well, you have to pay us $1,000 a month. You have to be able to rent this property out for at least $1,250 to $1,300 a month. So that way, we feel comfortable knowing that you're going to be able to pay us back our $1,000 a month, and then have that extra 25 to 30% left over to then operate your property and then hopefully make a profit. By the way, banks don't care if you make a profit. They just care that you can pay them back and manage your expenses so that you can keep paying them back. So now the way that the investor looks at it, or at least the way that I look at it, I like to look at it as the expense coverage ratio. And just fair warning, this is a very conservative way to look at it, because you really have to be in areas where you can get these numbers to work, or you really have to be diligent in not jumping in deals where the numbers don't work. But that disclaimer aside, the expense coverage ratio that I like to look at It's saying for every dollar that I have to pay an expense, I want to be able to, charge or bring in income or charge for rent, bare minimum, $1.30, to $1.50. That's just bare minimum. So what that means is, let's say I have let's say my monthly expenses for a property are $1,000. So that $1,000 includes mortgage, property management, maintenance and repairs. I include, the typical vacancy, all that. So let's say with all that, I calculated down my expenses are $1,000 a month. I want to be able to charge at least, let's say, $1,300 to $1,500 a month in rent. So what that means is, I know I can pay my mortgage. I know I can pay my property manager. I know that I can pay for repairs and maintenance, and then also have money left over, because if all that combined is $1,000 a month, I'll also have now $500 a month left over for profit. Or you can also, profit slash, I'll say, capital expenditures if that's not included. So that's a way of looking at it. We're saying I need to make sure that my rent payment doesn't necessarily just go to service my debt, but it has to service all of my expenses. And then I want to be able to say that I have X amount of money left over on top of that each month that then goes straight to my profit. So in that scenario, let's say your rent was $750 each month, and then your property management expenses, let's say, is $150 each month. So now that's $900. Let's say your repairs and maintenance on average is $100 each month. So now you have that $1,000 that you're paying out every month, but you're charging a rent at least $1,350 to $1,500. So now that's $350 to $500 each month that you're making in profit, that you're able to set aside for profit. And then from there, the way that you can then also stress test to make sure that you're not over leveraged, or to see where your breaking point is, you can then start doing reductions. So you can say, okay, well, let's say my income decreases by 10%. What does that look like? How what number does that then have to then where I'm potentially running the risk of just barely meeting my payments? So on the first scenario, where let's say your where the bank is looking at it, you have your mortgage payment was $1,000 a month, and then your rent, let's say, was $1,300 a month that you were bringing in. So your income was $1,300 a month. So now let's say your rent decreases by 10%. Now all of a sudden you go from making $1,300 a month to now only making what's that? $1,170 a month. So now you're only making $170 versus $300 a month. That then has to go to still cover all those same expenses. So now you still have, let's say, all the same expenses, but now you're bringing in $130 less. There's a good chance that now within that $130 that you're missing out on, something's not getting done. Your repairs probably aren't getting done. You're probably going to now start having deferred maintenance, if you were just going by the way that the bank looks at it. So now, let's say in my scenario where I'm basing it on the expense coverage ratio, I can say, all right, let's say my income decreases by 10%. So let's say all of my expenses altogether were still $1,000, and then let's say I was only at 1.3 times for my expense coverage ratio. So I was charging them $1,300 in rent, and my expenses decreased by 10%. My income decreased by 10%. Now I'm only making, once again, $1,170, but all my expenses are still only $1,000, and I'm still bringing in $1,170. So I'm still able to cover all of my expenses and then still pocket $170. So that's the way that you can stress test it. I kind of go more. I have a link. I have a YouTube video that kind of goes into everything. So you can click the link in my bio.